Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome Brent Ritchie. Hi, Brent.
Hey, Mike. Thanks for having me. Honored to be on the show.
Thanks for coming on a podcast. And just a couple of words about Brent. I'll let him talk more about himself, but we've done a couple of investments with Brent. One, have gone full life cycle in Phoenix. We're pretty happy with the deal. And then we have another deal with him in Dallas, and he is a multifamily and commercial operator with partners. He's got, forgive me if I am wrong, but from what I understand, you got over 3,400 doors, and you're managing 2,300 actively. Does that sound about right? And tell us a little bit more about Brent, and then you also a partner in a mastermind group. So tell us a little bit about Brent first.
Awesome. Yeah. So again, humbled and grateful to be on the show, and hopefully we can add some good value for your audience here. So I grew up in a little rural small town outside of London, Ontario. It's about 2 hours, 3 hours from Toronto, Ontario, and grew up a Detroit Red Wings fan because I was closer to the Red Wings there. Yeah, it was just always kind of went along this journey. Had more of an entrepreneurial bent, but ended up doing engineering, and then shortly kind of got into the multifamily space back in 2017. And so I think a lot of that analytical engineering background really married well with this space, kind of looking at a lot of numbers, crunching numbers, living, eating, and breathing in numbers. And so yeah, that skill set allowed us to really be able to uncover and see a lot of opportunities in the sector and space, and be able to model various scenarios, look at stress tests and see where, we would see, kind of like Wayne Gretzky talks about, see where the puck is going and see where opportunities are kind of coming down the line. And that's really what we do now. I know I just kind of capture that 20 years lifespan in about a minute and a half. Yeah, we're really kind of always looking at a lot of these fundamentals have patterns, right? And we always look for, where are these patterns going? Where's the population growth? Where's the migration? Where are the people moving? Where are the jobs being created? And that's really a lot of the core fundamentals in the multifamily space. And so, kind of back 2017, really started getting into the space, bought our first asset in Glendale, Arizona, in that Phoenix MSA, and grateful for your partnership on that opportunity. And we really started looking at kind of a bit more agnostic and just opportunistic for location. Hey, where do numbers make sense? Where can we find great returns, find great projects? And so that led us kind of building and scaling and growing in specific markets, Dallas, Houston. We had the property in Phoenix that was a great success. But then as markets got really, really hot, everybody else kind of heard about the rumors. And so now everyone, floods in that market, and it gets hyper competitive, and maybe the numbers don't make sense anymore, or you really got to push deals to make numbers work. And so, that's where we'd be a bit more, I guess, agnostic, and just seeing where we gotta, kind of uncover some opportunities. Let
me jump in. So let me jump in with a couple of comments here. So obviously you're a big hockey fan. You grew up in Canada, Detroit Red Wings, and they were super good for many years. They go in cycles, so it's a great franchise, and obviously where the puck is going, Wayne Gretzky, right? Just kind of preparing or thinking where the future is going to take us. So is that the reason why you're going to Texas, Houston? You said Dallas. Obviously, there's a lot of inbound migration, right? A lot of people are moving from both the left coast and the right coast. It appears that the job growth, Texas is one of the probably great growth markets. So I assume that's why you kind of settled down there. And what are you seeing now? I mean, we're recording this episode in the middle of October 2023. Things obviously have been changing quite a bit. So what do you see coming? I'm just curious, so these trends have been around. Texas wasn't discovered yesterday. It's been a growing state for many, many years. The growth continues, but the prices have also gone up quite a bit. Many, many assets have appreciated significantly. And how do you buy right? How do you get a great deal in this environment?
Yeah, I think great question. So debt has a massive play in assets, and there's a huge, I would say, creates a lot of challenges, right, for existing deals. And you got debt and insurance are two of the major factors, especially anything coastal. So Florida, of course, insurance is wild. Texas, especially anything coastal, Houston, insurance is pretty wild. But then, yeah, that debt factor. And so we would really see that both create issues and opportunities. Issues, hey, if somebody brought, bridge debt deals, which, 95% of the transactions that were out there transacted in bridge debt, right? So those deals, as the rate caps matured, or maybe people didn't buy rate caps, they didn't anticipate the cost to go up so dramatically. And so there's a lot of owners who kind of were not anticipating the rapid rising rates that we've had. And so I know if we've had great conversations about, hey, let's take a broader perspective back. These rates that we're having now are not abnormal. The rates that we had a couple of years, for the last couple of years have been way too aggressive and way too low. And so the opportunistic side is because the rates have gone up so high, it really reduces the price, it reduces the price of these assets. And so, if we're looking at these assets, and, I think the analogy in this mastermind was, hey, if your friend's Ferrari, the price of them are 300,000 and you see one on sale for 150,000, for 200,000, you're like, that's a great price on the car. And so it's kind of the similar in the multifamily space. You're seeing these deals that were trading significantly higher now that are quite a reduced discount. There's the be greedy when people are fearful, be fearful when people are greedy. There's a lot of fear right now in the market. And so that's causing a lot of people to step back and not engage in the market. The Dallas-Fort Worth Metroplex, we're still, crazy enough, you get a 19 or 2000 and newer vintage asset there, you still get like 40, 50 groups touring and putting offers on those deals. So that we're not seeing, like 40 to 50.
How do you find a great deal in this environment? So we're back to the question. Everything you said makes sense. The rates are up, right? The market has moved up. The pressure is built very fast. People who borrowed variable or floating rate debt are feeling the pain. Now, how do you get those people to capitulate if you're buying, right? Because basically, when the interest rates go up, the theory is the cap rates have to come up, right? I mean, that's the basic premise. But because people are not used to that adjustment, and then they're not willing to capitulate fast. And then, as what you just said, a lot of groups are still floating out there looking to buy at these great markets. So how do you get great deals? Because if you don't get a great deal, you wind up in a position where the rates are high. It's expensive to buy. It's expensive to finance. And if you're not getting a great deal, you're not getting your $300,000 Ferrari for 150. You're getting it for like 275. And are you really getting a deal? That's the point. How do you know? How do you think it's going to play out? And will it play out in those hot growth markets? Will the discounts be significant and in any kind of reasonable volume, or it's going to be one-off market, deal that kind of flows beyond the radar screen, and those who can get it, but everyone else is just still going to be running around looking for deals? What do you think?
Oh, Mike, that's such a good question. And there's a lot in the relationship business. A lot of this business is done, people do business with people they know, like, and trust. And so, yeah, I think generally what's marketed on the deals today, like if it's in that Metroplex, in the DFW Metroplex, you're seeing still a hot competitive market, lots of people chasing those deals. And so you're not seeing those discounts. And I will fully admit I cannot predict the future, and I don't think I'll ever be able to, but I wouldn't foresee that Metroplex going in the opposite direction. It's a bit of a flight to safety, and the fundamentals are so strong there, and the politics are so strong there. You're seeing that, and so it's a bit. I would say
for a second. Let me just stop you there for a second. So if I'm hearing you correctly, Dallas Fort Worth Metroplex and other healthy markets, the demand is fundamentally so strong relative to the supply that the fact that there is dislocation in the cost of financing, you don't think that the prices are likely to correct significantly, or maybe at all, just because it feels like a long, if you bought it with fixed rate debt, you're not feeling the pain. And but the experience of new buyers is a whole lot harder than the people who bought a few years ago, because you can get 60% debt leverage, maybe 65% max, right, in this environment. So the question is, how do you actually transact? I mean, that's why transaction volume is down heavily, and it doesn't look like it's coming back anytime soon, unless sellers start capitulating, because buyers ain't willing to pay $300,000 for Ferrari. They're looking for the $150,000 Ferrari, but they can't find them, especially not in Dallas Fort Worth. So it's kind of one of these really interesting phenomenon that fresh money wants the great deal, but how can it get a great deal?
Yeah, that's so. I think a little bit of relationship business. I think if we look at so much deals, transaction bridge volume, some had rate caps, some didn't, and so you had variable rate debt, and so now a lot of these deals are struggling, or the owners are in trouble, and so some of those are private conversations that are being had, or brokers that have a select pocket group of sellers that they have relationships with that they know can close, right? And especially right now, you're also seeing the dynamic factor where equity is kind of afraid too, and so equity is on the sidelines. And so that's you're looking for more of those opportunistic opportunities. And so some, I think pocket relationships, one-off deals in the Metroplex, I would say. Other markets, maybe we talk about Houston quickly. There you're seeing massive opportunities because people are a lot more kind of just you're sizing for new debt and insurance. Those two factors are quite extensive, and so it's causing a lot of people to pull back, and there's so much uncertainty in what's happening in the debt market ahead of us. And so it creates an opportunity when there's a lot less people in the market kind of chasing deals. And so we're seeing that market softening, but also being able to find and uncover some great opportunities in there. So I would say we look at that fundamental, we look at the supply demand, you look at the Class A coming in, any startups, if it's not already in construction, it's just in permitting phase, a lot of those projects are going to be, shelved and put off until the cost makes sense. Because for developers, it doesn't make sense anymore because your interest costs are so high, right? And so you're going to be holding off on those projects. And so now you're slowing down your pipeline of what's coming, and what's coming down. And so we're bullish on the long-term plan. I don't think these deals, even though in 17, 18, 19, 20, 21, they transacted, 6, 12, 18, 24 months, right? Which is I'd say very atypical for this sector, right? They're supposed to be, real estate is not a
5-year term.
Yeah, it was just transacting so fast. It set this, I think, unrealistic expectation. So we're looking kind of from this point here into 5 years, 7 years, 10 years in the future, right? That's where I think we got to look at that horizon and see what's happening in the multifamily space. Do the fundamentals make sense? And nobody can time the market. We're not going to be able to time the top, the bottom. What the future holds. I know the previous chairman and CEO of Goldman Sachs. He had a great interview with IPA a couple weeks back, and he's, they're kind of looking at those long-term fundamentals, and they're very strong and bullish on the space overall, right? We just had an atypical reaction and COVID and money printing and, rent skyrocketing really high with and transactional volumes just going wild with cheap free money, and that, music stops. And so, they maybe are talking about, maybe we have one more 25 bip, maybe there's another, who knows? And then, kind of next year, maybe spring, summer, we're looking at things starting to cool down. And so I think long-term perspective, if you step back, you see when rates are going up, people pull back. When rates stabilize, you kind of know what you're working with. And when rates drop, you see a market kind of come back a little bit further. So it'll be an interesting time ahead for us all. But I think, if you stay true in those fundamentals and you stay true with what's, just your product, and people need a place to live, and, people are moving to a market, and they typically are going to kind of rent first. And you have this massive gap between rents and your affordability for buying a home, right? So like you were talking about, leverage and everything's pulling back, but you got this big gap. And so I think it's only going to exasperate and encourage this renter market further. So it's real estate's, we can talk about the macros, but really, if you're looking at assets and you're looking at the micro and you're looking at what's happening in that product and that submarket, where are true value adds. And another point you talked about, and then I'll stop rambling. Another point you were talking about is where are those opportunities? And I think some of those are just, hey, great asset, just the ownership group didn't anticipate rates being, some of these bridge rates are going to be 8-9%. And so they didn't anticipate these rates being so high. And so it could be a great asset. Some of these you're seeing 2000, 2005, 10, 20, in that vintage that would typically be, your institutionals playing in that space, taking up those assets, but they're not playing right now. And you're not seeing them transact. And so, some of the opportunities are really in those great, solid institutional quality assets where we're able to go in and see opportunity and find those gems.
Yeah, I appreciate that view. I happen to agree. You want institutional quality, you want good stuff. Somehow you want a motivated, distressed owner. In the primary distress today is they borrowed the wrong money. I mean, floating rate debt, and that's a common behavior. It's a common problem, and all that is on top of kind of any adjustments. So the motivation, the seller's motivation for floating rate debt is significant, but then obviously, if it's a coastal property, insurance adjustments, any of that stuff. And just curious what you've seen in Texas on the insurance adjustments. In Florida, it's been absolutely insane. So is Houston, insurance rates have gone up sometimes 3x. I didn't say 30%. I said 2-3x, and it's obscene. Is that is that your experience too? Is that the risk today? Well, you have to underwrite for a large insurance bump. And these bumps are so large that it's almost scary. It's almost like you either get ultra conservative and then you can't even pay close to the price that it's the issue. What price the seller is willing to accept, and you could offer them a super low ball price, but it becomes a question of what the market forces will do. But just tell me a little bit about your experience seeing insurance. Prices going up.
This is great. Definitely the boots on the ground. I complain about insurance in Texas, and then I look in Florida, and I live in Florida. And I'm just like, what? It's if it's 1980s or older vintage asset in Florida, my gosh, we still actively underwrite and look in this market, and some prices we're looking and we're seeing like 4,000 a unit for insurance, and it's just almost strangling a lot of these deals. Texas, we did see a huge bump, like you said, 2 to 3 times the rate, and those are like non-coastal properties. Anything, if you're looking south side of Houston and you're looking, Clear Lake, Galveston, anywhere there, those costs have just, skyrocketed dramatically. And so
inland, it's 2 to 3x inland, and if you're near the water, what does the number look like?
Oh, geez. We avoid those areas intentionally and specifically. So
because you can't even do the math. You can't even underwrite, right? You just can't.
Yeah, exactly. You're 500-600 a door, maybe 700-800 a door. You're looking at 3,000 a door. And nobody underwrote that. Anybody that was
3,000 a door versus 600 a door. It's 5x. And what kind of rent per door are you charging?
Yeah, I mean that's it too. Your rent's just, you haven't seen that enough of an increase. And then of course you got your risk factor of if there is an actual event or if there is an actual storm, we haven't even talked about deductibles and everything else and what you take on as an ownership in a project. And so I'm loving away from the coast more in Florida, Central Florida, further away from the coast. And just kind of taking some of that risk factor down. I would say typically everybody, and I know we're gonna a couple more minutes, everybody is kind of in the same level playing field. So if we're looking at a new deal, if we're evaluating a new deal, pick a market, and we're looking at insurance, that is typically going to be that cost what everyone's looking at, right? We're all in that, hey, we're in the same debt boat. Insurance is pretty wild, and so plus or minus we're going to be all facing that same music. So yeah, I would see those create the issues, but then at the same point create the opportunities. And so we're bullish, I guess, on the fundamentals, and then really just kind of undercovering and finding those opportunities. You talked about that bid-ask gap. Hey, where do numbers make sense today versus where does the seller want to sell it? And often that gap is still substantial. And so, we're staying true and we're putting bids here and let the chips fall where they may. And, we'll keep looking and uncovering those opportunities.
Yeah, I hear you. Because one of the biggest problems is raising capital. You could make an offer, you win a bid, and let's just say you underwrote what you think conservatively. The challenge is most of the investors need to be convinced today that it's a great deal, not a good deal. And another big challenge is most of the investors are tapped out. It's one of the big problems of the whole industry. Investors kept making great money in the space. They kept cycling money from one project to another. But whatever the last set of projects they're in, those projects are kind of stuck, right? I mean, whatever they are, they can't get an exit point. Transaction volume is down. So that cash is not coming back. Even if they were bought reasonably well, value add was executed reasonably well, unless they get an exit, folks don't have the cash to redeploy. And many of them are nervous. So it's kind of an interesting situation where the whole industry is talking about, so folks who never saw any kind of bleeding, now they bled. So some projects are bleeding or may bleed, so they're very cautious after years of completely being infallible. Everything just goes well, up and up and up, and now it's wait a minute, things can go wrong. So convincing these folks to write fresh checks, they're getting a lot more cautious now. Now you got to get new folks to write you fresh checks, and new folks are entering this world where everybody's nervous and cautious. So it's hard. So what do you do on an equity side? How do you tell people, hey, I got a great deal, and not only I got a great deal, write me a check? I'm just curious your thoughts.
Yeah, no, that's a great thing. And I think if you're just trying to find a market rate deal and it's it's nothing really special about it, I think those are a little bit more difficult. But I know one of the deals
beyond difficult, they're impossible. If you come in with a market rate deal, what do you mean market rate deal? Well, you're not you can't convince your investors you're getting a great deal. You're just getting a deal. The inflation will take care of the business. The tide that rises all boats. But the problem is, the tide may be receding now. You got to convince them that you're buying deep enough, right?
Mm-hmm. Yeah, and that's it. So it's like, and that's where we spend a lot of our time, a lot of our effort. Probably looked at over 200 deals, underwritten over 200 deals. Getting into the weeds of it just to really see where we're putting offers where we're comfortable, where we think it's a great opportunity or fantastic opportunity, but not where it's, like you said, just a good opportunity. Maybe it's a marginal project. And so I think it just takes a lot of those relationship building with the strategic partners, and then also looking and uncovering or uncovering a lot of those projects, and you're going to find somebody that's needing to sell, somebody that has to transact, and so that's where we'll be there for it. And with those, when you're seeing that $150,000 Ferrari, you're like, I want to buy that, and I'm gonna make that work. So
we're almost out of time, but the final question: how would folks get a hold of you? What's the best way to reach out if they wanted to learn more a little bit about how you do things, the markets that you operate? What's the best way to get a hold of Brent?
Awesome. Yeah, thanks, Mike. So to get a hold of me, really to see, some of the opportunities that we look at, EnRitchInvestments.com, EnRitchInvestments.com. Yes. Yeah. So that's the best way. There's a contact form, and we could book a time, schedule just a quick conversation, make sure it's the right fit. And again, yeah, thank you so much for the opportunity to be on the call.
Thank you, Brent. Appreciate your insight, and wishing you good luck finding the next great deal.
Thank you, Mike.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.